Good afternoon and welcome to BizTech Asia's Midday Market Watch. It's the 15th of March and it's Friday, so everybody's got lots of smiles on their face. I'm Jeffery, Halley, and my co-host today is Samantha, Voon, and we are joined today by our regular guest and a friend of the channel, Kelvin Wong, Senior Market Analyst at OANDA in Singapore. Kelvin, as ever, welcome to the show.
My pleasure, and happy Friday to Jeff and Samantha as well.
Excellent. Before we get underway, we'll have a look around Asia's stock markets as we normally do, and we can have a quick chat about that performance for today. So in Japan, the Nikkei 225 is down 0.62%. In fact, it's a sea of red across Asia Pacific today. Shanghai has fallen 0.26%. The Hang Seng is down 1.98%, hovering around 2% lower. In Australia, the ASX 200 has fallen 0.8%. In South Korea, the Kospi is down 1.59%. Singapore is in retreat, falling 0.27%, with Kuala Lumpur down 0.22%. Kelvin, a sea of red there, a pretty ugly end to the week. Can you walk us through what's going through investors' minds?
Yeah, sure. So if you look at the current negative kind of a risk-off scenario that's being, I put it away, kind of a mini intraday risk-off scenario, is primarily driven by the fact that we have a kind of not so soft, we call it inflationary metrics up from US, which was the producer price inflation. So this producer price inflation is more or less talking about costs of businesses having their raw materials or inputs that potentially could trigger down towards the consumer inflation trends as well. So what I could see is that yesterday the core PPI data for US year on year coming in at 2%. So that is not really a very hot number, but what it seems to us that based on 2 consecutive months, it's been staying at 2% after decelerating from 3% plus about 6 months ago to 1.8% in December. So it seems to us that the deceleration mode has started to plateau off, and potentially that could actually make a bit of what I call uneasiness among the Federal Reserve officials to actually enact their Fed dovish, we call it pivot, that market has really started to price in optimismly since the start of this year. So if you look at the situation right now, initially at the start of the year, market is looking at 6 interest rate cuts by the Fed. And as we start to see new data coming in, indicating the US economy is still rather robust, and as well as inflation data is not as deceleration mode as what the Fed wants. So that actually put off the, what you call it, liquidity easing pedal a bit. So from 6 interest rate cuts now has been priced in at 3 interest rate cuts. So what we could see over here is more like a sucking out of that dovish pivot optimism that was priced initially at the start of this year. So that actually explained that kind of, we call it a mini risk-off scenario that we're actually seeing right now in the markets.
So Kevin, the US PPI came in higher overnight, right? That followed higher than expected inflation earlier this week. So the US dollar has rallied strongly across the board. Walk us through that, and also are markets finally starting to price higher for longer from the Fed?
Yes, but if you look, I would say that pricing higher for longer is not certain at this juncture by looking at the movement of the US 10-year Treasury yield, because it's still holding below a key major resistance level at 4.5%. So yesterday, it actually traded up much higher in terms of a intraday movement of that US 10-year Treasury yield. So yesterday jump was actually, let me have a quick refresh on my chart. Okay, so yesterday jump was actually close to 10 basis point from 4.14 to all the way up to 4.28%. So that was a pretty significant intraday jump. So that 10% basis point jump is actually the most in close to about a month for a single day performance. So due to this significant jump in the US 10-year Treasury yield, but led to this stronger performance overnight. But we are talking about whether the market has started to totally write off the Fed dovish pivot at this juncture. It's not certain. Why? Because the US 10-year Treasury yield is still hovering below the major resistance of 4.5%. Unless we have a clear breakout of that 4.5%, then for sure rates are going to stay higher for longer. So that could be a very, very detrimental factor for risk assets like stocks.
And just to jump in there, you were talking off screen before the program about the dollar index, and it's looking quite. It's rallied obviously overnight, but from a technical perspective, it's made some interesting levels.
Yes, yeah. So if you look at it, yesterday we do see intraday rally overnight. So what's this intraday rally came was last week, very weak performance. So last week performance in terms of a weekly basis was the weakest that we see so far in the last 3 to 4 weeks. So what we could see very interestingly that yesterday rally actually retraced close to 61.8% FIBO retracement. And this retracement actually now led the dollar index to rest right below a key near-term resistance level at this 103.70. And very interestingly, this 103.70 also coincided with 3 moving averages, the 200-day, the 20-day, and the 50-day moving averages. So as we know that we now come close to the end of this week. So for sure, today's price action will be pretty much critical on this dollar index. So if we start to see dollar index getting a bit hesitant to break above this 103.70 level, so perhaps we may just indicate to us that yesterday's strong dollar movement maybe just a blip within a very messy price configuration that is playing out on the FX market right now.
Right. Let's have a quick look at next week then. Huge week for central banks. Of course, we do have the US FOMC, but in Asia Pacific, we have rate decisions or rate announcements from China, from Australia, from Indonesia. But I think the one that is going to catch the market's attention the most will be the Bank of Japan, and whether after seemingly decades it's going to end its zero interest rate policy. Can you walk us through some scenarios for the Japanese yen over that BOJ rate decision?
Yes, precisely. So if we start to look at it over here is that maybe we talk about the price movement of the yen first. So what we could see in the last 2 weeks or so, the yen actually rallied significantly against the dollar. That means we're talking about looking at the dollar yen plunging from 150 figure level to as low as 147 this week. So that's close to about 3 to 4 big figure decline. So this decline in the dollar yen is actually kind of front running or in anticipation of the BOJ next week getting much more, we call it forceful in terms of normalizing their ultra dovish monetary policy. So if you look at across the rest of the world, there are only central bank that has a negative interest rate of negative 0.1%, the short-term interest rate since I think 2016 level. So the key reason over here is that if you look at the start of this week, we are now coming towards the way that the first preliminary result for this annual Japanese wage negotiation between the unions and the corporations. So in this week itself, we have Toyota and those car manufacturers rising their employer wages close to 5%. So that's a very rosy number. And in fact, today itself, by today, we should be receiving the preliminary wage negotiation results report, I would say, up from Rengo. So Rengo is the largest trade union federation in Japan. So market is actually looking at an average rise of 4.10% annual wage for this financial for Japanese employees. So that's above the average rate rise of 3.58% last year. And if it comes in at 10%, it should be the highest wage rise since 1992. Yeah. So particular wage result is very important. Why? Because in the last few minutes meeting by BOJ, Bank of Japan governor, especially Yuda, he did mention that in order for Japan to be much more confident to actually start normalizing their short-term negative interest rate policy, is that he got to see evidence that wages are on the rise. Why? Because once wages on the rise, it will translate to much more substantial demand pull inflation coming back into Japan, and that could actually increase the probability that Japan has indeed rightfully and forcefully exit from their deflationary spiral environment in the last 30 years or so. So for sure, there's a lot of expectation right now that is being priced on in the interest rate swap market. And you look at the way the 2-year JGB yield has risen from close to about 0% at the start of around January, all the way now up is actually risen up to high of 20 basis points, that's 0.2%. So market seems to be pricing in high hopes that potentially we may start to see the first interest rate cut in Japan to take shape in next week. But we should see how it plays out from here, because there is also no certainty. Why? Because despite the fact that today's wage negotiation results is only the preliminary report. So coming towards the middle part of this month, we will have the second preliminary results from Rengo in March 22nd. Then after we have the finalized result up on April the 4th. So if BOJ will adopt a much more cautious approach, they will wait until the release of this third tally of the wage negotiation result out to be much more certain. So that's in April, the 4th of April, before deciding in the next meeting in April the 26th. So, but perhaps this is either 2 days, either next week or April. So we'll see how the story plays out, and most importantly, the guidance given by UDA itself. And also there's also some speculation going on that they may totally scrap that 1% upper limit reference rate on the 10-year JGB yield. So that scrapping of that 1% upper limit on the 10-year JGB yield potentially could actually see a bit much more further yen strength coming back into the picture.
Okay, excellent. Kelvin, as ever, comprehensive answers, and thank you for being on the show today.
My pleasure.
We've been speaking to Kelvin Wong, Senior Market Analyst at OANDA, based in Singapore, on BizTech's Asian Midday Market Watch. I'm Jeffery Halley.
And I'm Samantha Voon.
This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it with our syndication partners, TV, radio stations, and websites. Thanks so much for tuning in today, and have a wonderful weekend.